Good morning, everyone, and welcome to our first coffee break of 2015. This morning, we'll be talking briefly about getting back to banking basics and how to drive growth in 2015. I am Marika, a principal in the financial services practice here at Treasury Strategies.
My name is Dave Robertson. I'm a partner leading the financial services practice for Treasury Strategies. And we're excited to present this first coffee break with you early in the year, trying to give you some ideas that can help you have the greatest impact on your success in 2015.
As we've worked with many of our banking executives over the past couple of months, we are hearing some really great things. Those at the top of the house are recognizing the transaction banking business as a powerful and stable source of revenue for their overall enterprise. And with that recognition, many banks are charging the executives of transaction banking to grow their business tremendously, setting targets of up to 8 to 10% in some cases. And while that's a fantastic goal, and we're glad to see the recognition of the business, there are numerous headwinds facing our industry this year. We're seeing disintermediation by non-bank players, especially more and more commerce going into the virtual marketplaces that are bypassing the banks. We're seeing intensified competition for deposit and operational share in our post-Basel III regulatory environment. We're seeing peer consolidation across the board, and scale dynamics making some businesses unattractive or unfeasible in some cases. These are just a few of the headwinds that we're seeing. So Dave, the question is, in the short term for 2015, is there room for net new growth in the industry to hit those 8 to 10% growth targets? And do I have the investment and business model to hit those targets? Or is this a zero-sum game? And if so, how am I going to win share?
So Marika, I think the question is, we've got our fish feeling constrained by its fishbowl in a mature market. Is there room for growth? And secondarily, once there's heightened competition, how do we even hold on to the growth that we have? The way we look at this is that the best opportunities obviously are to expand the scope of solutions or the market, but that takes time in this industry. One of the wonderful things about the transaction banking industry is it produces stable annuity relationships. That's the good news. The bad news is it's a hard-fought battle to win those relationships, and it's not something that you can just instantly flip a switch and start stealing share left and right. So as we face 2015, there's really two thoughts here. One would be if you already have market and product scope solution expansion underway, by all means, focus on that and leverage it. But if that's not really going to be a fundamental driver of your growth in 2015, it's time to turn to much more tactical effects to generate growth. And as you pointed out, Marika, I think with Basel III, the liquidity coverage ratio is going to focus banks very intently on winning, retaining, and defending the operating relationships. We're going to see probably at the margins intensified fee pricing competition, and maybe even in a rising rate environment, higher earnings credit rates in the U.S. to retain that business. So what this focuses us on is, how do I get more business from my existing book? How do I deepen revenue with my existing clients? And yes, at the margin, how do I win share and how do I retain share in the marketplace? So Marika, that raises the question, if I don't have a scope solution, a market scope underway, how am I going to win new revenues in 2015?
Well, I think it's time to get back to banking basics. You know, we've all been under a lot of pressure over the past several years with regulatory and compliance scrutiny and haven't had a lot of time to focus on actual strategy to drive growth of our business. So I think we can focus on 4 key areas of driving growth this year. We'll talk about pricing and revenue management, sales effectiveness, client relationship, and also some short-term product enhancements. If we think about pricing and revenue management, I think there's 2 areas that are going to be critical for growth this year. We can look at activities to enhance existing services and pricing, and of course, pricing the new deposit and fee products appropriately. When we think about existing services, it's important to focus on pricing for value and enhancing the governance around the standard and exception prices creating a more scientific approach to deal with both deal and portfolio pricing. There's also managing revenue leakage. So we may be setting the right prices, but are those getting executed into the markets? We need to look at operational considerations, billings and collection processes, and the product continuum. And of course, there's also the opportunity to take share through pricing of new deposit products as we enter the post-Basel III world. The second area of focus is sales effectiveness. Can we target some adjacent markets and extend our footprint beyond where we are today? Sell services further down market into the small business space? Sell deeper into the relationships we already have? And then also make sure that we have a really strong value proposition for enticing clients to switch over to our bank. Oftentimes we hear, well, our value proposition is our relationship with clients, but that's likely not going to be enough to get a client to switch from one banking provider to another.
So picking up there, Marika, I think you pointed out the whole issue of relationship. We've seen a real interesting trend in the industry, which is that competition on feature function, it's still present, but it's far less important than the overall customer experience. And what we're seeing in the market with our corporate clients is that they are increasingly selecting their providers based on the overall experience. Our corporate treasury and CFO controller personnel probably have more time pressures than ever, and they need things to be easy, advisory, and accessible. So when it's time to bring additional business, they're going to go to the bank that makes it the easiest. And so that's one area for 2015 is really improving the client service relationship. In particular, we've seen many banks make great strides in making their onboarding processes easier, which is accelerating their time to revenue, but moreover, they're winning a bigger share of wallet with their clients because their clients are turning to them for additional business. And if we think about that, this is even more challenging in a heightened regulatory environment. The hoops that banks have to go through on KYC and due diligence is making it more and more imperative that the overall onboarding process is as efficient, streamlined, and transparent as possible. So in the short term, obviously you're not going to deploy a digital onboarding system, but simply having role clarity, having great metrics, strong SLAs, good internal process management, good management of legal documents, and just basic excellent customer communication is going to make that experience very strong, and it's going to help you win and retain more business. Now, I know we also talked about product scope, and that's difficult to deliver in the short run, but that doesn't mean that product is off limit as a means to add revenue in 2015. There are short-term enhancements that can be done. So a couple of things that we're seeing that are having the greatest impact, first of all, would be engaging with partners to rapidly deploy solutions to market. Now, I know rapid in the banking space is a little bit of a tricky word. Obviously, there's due diligence, there's the whole infrastructure that needs to be put in place. But if you are leveraging a third-party solution that's already built, that's commercially viable, that can get you to market much more quickly. And we're finally starting to see banks, I think, get through the compliance hurdle and now look to expand their solution set with the help of partners. We've been seeing very creative partnerships, both on the consumer side, but also on the wholesale banking side, and bringing in some of these emerging fintech companies. The other area, I think, is that we found that we can make products simpler and easier to sell down market. And that doesn't necessarily mean re-engineering the product, but maybe streamlining how you talk about the product. A classic example would be, how do I sell lockbox to a 5-person law firm? Well, the lockbox might make great sense if they're traveling and it's very difficult for them to get to revenues. So some of these sophisticated products can be sold down market if they're streamlined, the pricing is simplified, and the value proposition is made clear and relevant to a small business or a business banking client. And then lastly, I think it's fair to say that banks have many wonderful products that they've just never really launched and commercialized effectively. One of the things we do with our clients is Treasury Strategies will segment their price list along the product life cycle, and all too often we see that the value-added services have very low penetration. We think in 2015, it's incumbent on all the banks to look at that value-added product set and really think about deploying it far more rigorously and aggressively into the customer base. So you may have cross-sold a client completely in terms of the breadth, but how deep have you sold that client? Are they getting all the value out of the bank they can? Not only will you generate more revenue and higher margin with those value-added services, but you'll also deepen the relationship, and that will position you to defend that relationship in the face of intensified competition. So from all of these, there's a ton of benefits. First of all, everything we've talked about is a relatively low-cost way to drive growth. We're not talking about investing $50 million in a new web channel. Secondarily, these are short-term benefits that can help you hit the banking goals that are being set for you, and quite frankly, you're going to have to hit on multiple areas here to meet the targets and exceed industry growth. As we mentioned, this will deepen your relationships. That will defend your portfolio. It will also ensure that you further penetrate your credit client base. And one of the things we've seen is that a credit client that has been fully cross-sold typically has an additional 2 to 5 years of relationship life. And then I think also by beginning to partner with the non-banks, you're going to expose your bank to more innovation. You're going to get more understanding of that whole ecosystem, which frankly, we see far too many banks sort of just shut out of that completely. So we recognize that's a lot of things on the plate, and obviously every bank has finite resources that they can deploy to attack these growth opportunities. So I think that raises the question, Marika, where do we start if we have these opportunities to pursue?
Well, I think, Dave, step one is looking at our current state. So taking a look across each of those 4 areas we went through, pricing and revenue management, the sales effectiveness, the relationship, and product, and really taking a good look at where we stand against our peers versus what the market is demanding today and over the next 12 to 24 months, and assessing how large the gaps are in each of those areas. And once we know current state, then we're able to look at the different options in terms of benefit versus the difficulty to deploy some sort of solution to correct that gap. And each of those can then be prioritized based on how large that gap is and what the type of benefit and the level of benefit would be to filling that gap. And it's going to be different for each one of us. It may also mean that, as you mentioned, the banks may have to partner with some non-bank payments providers, for example, to deliver the solutions that they need to give to the market over a short period of time. So once all of that is complete, you can certainly look at the best course of action, prioritize your opportunities, and then talk to Treasury Strategies about that strategy over the next year.
So, Marika, one of the things I'd like to share is just kind of building on the points that you raised there. When it comes to really finding out where your opportunity is, one of the greatest things you can do is sort of benchmark your portfolio. And increasingly, it's not benchmarking to median, but benchmarking to best in class, because we are entering into a kind of almost a pre-oligopoly phase of the industry where most banks are doing, the basics quite well. And the trick isn't to do things just well enough, but how do I exceed that? How do I do best in class? And I think benchmarking your pricing, benchmarking the depth of your cross-sell, benchmarking your customer experience against the best-in-class peers will really open up your eyes as to where is my biggest and most immediate opportunity. And I think, we are seeing more interest in price benchmarking and pricing strategies from our clients. And it's not the same, let's go back to the well and just increase standard prices across the board. Many times it may be that your standard prices have been optimized and that's only going to give you half the lift. You now need to address your discounting, and that gets a lot trickier because those are clients that have already communicated to you that they're price sensitive. So in all these cases, I think we want to stress we're sort of the person in green there. That's a depiction of Marika. She's joining your side of the tug of war and helping you pull more share into your organization. I do want to stress that we've been down this path. We have a lot of benchmarks that will help you focus your priorities, and then we have a lot of frameworks when it comes to these elements to help you get to market quickly and start seeing some benefits in 2015. I did want to share with everyone who joined today, and thank you for joining, that we will be posting a copy of this available to you. If you do have questions, you can submit them in writing and we'll respond to them with the final presentation deck. You can also feel free to contact Marika or myself or anyone at Treasury Strategies. We'd love to talk to you about any of these topics. And our next coffee break is scheduled for about a month from now. It's Thursday, March 19th. It'll be the same time in the same place. And we're going to talk about Basel III. You know, I think most banks have gotten to the regulatory portion of Basel III, sorting out how to measure it. What we really want to focus on is the strategy. The regulators have created a very uneven playing field. We're going to see massive shifts in share, and that's an area where you cannot be aggressive enough in getting your strategy in place and getting to market. Thank you for joining us.